hold on, I'll introduce you and then you can go. Good evening, everybody. Hope everybody's having a nice spring evening. Tonight, we've got the good fortune of having Larry Gaines on with us tonight. We always get the question of, do you buy during earnings season? And so that's what Larry's going to kind of expound on tonight, and he's got some very interesting concepts. He's been doing a lot of trading on, doing international trading for a fund in the past, and he's come up with his own techniques that have been very successful. So with that, Larry, we're anxious to see what you have, and welcome to the Candlestick Forum.
Well, thank you very much, Steve, for having me here tonight, and thanks everybody for being here on this webinar for my presentation. Well, we're into that earnings season, and it can be, you know, a really exciting time of year, or it can be a really frustrating time of the year. So that's what I'm here to kind of talk about tonight with everybody. First, what we're going to be covering is how to find volatility and use it to your advantage, a screening process to find the most probable winners, my favorite trading tool for earnings trades, a 9-step stock trading checklist that I use and put together, and my favorite non-directional earnings strategy that I like to use. This is, you know, webinar tonight's purely education. Any stocks or anything else mentioned does not constitute advice and should not be construed as recommendations. So appreciate Steve's introduction. I'll give you a little bit more background on myself. I've been actively trading for over 30 years, and I previously was executive vice president of one of the largest oil trading companies actually in the world, and I ran their international trading desks in Bermuda for over 10 years, where we traded all the cash markets on crude, lots of crude, and all the different derivative markets, from, you know, anything from bond futures to S&P futures to foreign exchange. So, you know, had the opportunity and was blessed to see a lot of different trading things over my career. We were also, by trading desk, we were one of the first to actually start trading over-the-counter options on crude oil, and also then I went on to launch the institutional over-the-counter crude oil option brokerage desk for the largest privately owned oil brokerage company in the world, PVM Oil. So that was a fantastic experience too, just getting to see all the various different option structures. So, you know, a lot of background in trading, and now I'm out on my own doing my own thing. So I'd like to also start out with just a question to everybody here tonight, and, you know, maybe just type in a yes or no answer. But I'd like to get a feel for how many of you, you know, here would like to be more active in the markets trading, maybe as a full-time job, you know, and on your own schedule, of course, but maybe you're not quite there yet. I'd like to just kind of get a feel for everybody in the room here. We've got a great crowd, so appreciate that. I'm seeing yes, 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 lots of yeses. So that's what I thought I would see, and that's exciting too. So, and I wanted to go on from there and just say, you know, I was just like you guys, you know, starting out, and I still vividly remember when I went out on my own trading. And I was first very nervous having my own money on the line. It was such a different feeling when it was, you know, your own dollar. And, you know, I have a wife, 2 boys in college, mortgage, plenty of expenses. So, you know, it's a lot to think about when you're putting your own money out there on the line. Now, when I was running the international trading desk, you know, I found myself in plenty of nerve-wracking kind of trading situations. But, you know, at the end of the day, it really didn't affect me personally unless I blew up my boss's trading account, which I never did, thank goodness. You know, it wasn't my own, you know, it wasn't my own dollar at risk, my savings. It was the guy I was, you know, actually running the desk for, the owner of the company. He was extremely wealthy. So, you know, it's a different feeling altogether, as I'm sure all of you guys know. Now, trading, you know, for my own account really started to improve, however, once I learned how to better control risk. And the huge breakthrough for me was learning how and committing to limiting my downside in any trade taken. And I did this by using option spreads. Now, once I committed to this, then I could actually sleep better at night. And that's such a comforting feeling, as I'm sure you guys are aware of that. Sometimes it's hard to sleep when you have a big position on. And I also believe that probably 60 to 80% of a trader's success will come from, how you emotionally handle the markets. And it really comes down, to keeping in check those big-time emotions that you're going to have, or that will surface from, both fear and greed. But, when you know the maximum loss you can incur based on your trade setup, then, these type of fears can really be relieved. And the really cool thing is also that option strategies allow you to completely control your risk by using spread setups. So you decide ahead how much risk you're going to go and put on, and then you structure the trade. It's really that simple. And so I'm really excited about earning strategies. Now, even though the last several weeks we've had some increased volatility, from a long-term perspective, we've been in a time of very, very low volatility, which makes it harder for the option traders sometimes to find those really good opportunities. But with earnings season, you get those stocks, they tend to spike, and this allows for traders to capitalize on that uncertainty. And it's coming for 4 times a year. So I actually really get excited about earnings. If you're an option trader, what could be better than high volatility and knowing how to trade spreads, through it. So that being said, I just kind of want to put that out there, and then I'm going to, get started here. But, if you can't hold your questions till the end, and hopefully I'll be able to answer every question, or as many as I can possibly for tonight. Now, ask yourself this. What if you could add a new stream of income now? Now, would it change your life? And if the answer is yes, then do you have a plan to achieve it? Now, many type of income streams can actually take years to achieve, considering the amount of education work that's, required. But if you could learn in a few hours how to add a new stream of income by creating option spreads that capitalize on stocks reporting earnings, then, that might be a great thing to do rather than be sidelined all earnings season being frustrated. So, have you ever been confused by the weird movements, though, in stock prices during an earnings announcement? I call this the earnings confusion. You've noticed how earnings are horrendous and then the stock will go crazy, or earnings are off the chart fantastic and the stock goes down. It's like, what's up with that? When a company has an earnings conference scheduled, now many times, there's a great amount of speculation, not only to the accuracy of the projected earnings per share, but other factors that come in as well. So we saw one recently with Apple. That was talking about surprises. That was the ultimate earnings surprise, with the 7-to-1 split, the buybacks, and all the other stuff that they threw out there. So that's what, can make earnings season a very excited time of year, but also a time of year when traders can get frustrated because, you're scared and you're sitting on the sidelines, you don't know what to do. So, I always tell my clients and my members, you want to kind of embrace risk, so and look for those opportunities. So the uncertainty of all this typically causes volatility in the shares themselves. And the diamond in the rough is actually that temporary parabolic increase in the exchange-listed options on the underlying shares. So here's what happens now. The traders, will tend to stay on the sidelines going into the days leading up to an earnings conference. And then the call buyers come in. So they'll sell off their stock shares. They'll start buying calls. They'll go long those call options so they can participate in any rise should the shares move higher, but also at the same time limiting their potential loss if the shares were to trade lower. So you have all of that flurry of buying activity coming in. And this is going to cause those call options to trade in many cases at drastically expanded volatility levels. Now, additionally, then you also have the put buyers coming in, forcing the option prices higher as they try to protect their positions that they're carrying along. So you have all this hedging and maneuvering around, and it's all coming in a relatively short period of time. And this kind of activity, is something that a trader should try to take advantage of. It's that uncertainty and volatility that can really lead to some, great profits. no matter what those crazy earning reactions are, if you just know the right setups and how to put on the trades and the right trades to use. Now, step one is what I like to do is I will identify and qualify a particular stock, and I'll do this by looking at its past performance heading into earnings. So I want to find those stocks that have their earnings release closest to a weekly option expiration. And this will be a key theme, weekly options. That's a very key part of the way I like to trade into earnings. Now, step two, I look back and I will back test to see what volatility has done previously to a stock as it moves closer to its earnings release and after. So, a lot of times, the smart traders are going to be looking for this dramatic increase in the front and second month volatility a few days prior to those earnings calls. And a normal stock's front month volatility will usually be anywhere from 25 to 40%. But when the earnings start rolling around, and you start getting into that actual day when they're going to have their earnings announcement, that volatility really spikes, and you can see huge extremes of these volatility on your underlying stock shares. And if you think about it, this is what makes the stocks a potentially great trading candidate. Now, normally volatility will double, and sometimes you can see it even triple to get to those extreme conditions. And that's really what you want to look for when you're trying to put on some good earning type trades. And it's for this reason that it's essential to have a watch list of stocks to monitor closely, due to the fact that they may not all represent what I call an equal opportunity for an earnings trade. And you want to remember that the goal is to take advantage of the temporary rise in volatility. That's the whole game behind trading earnings. So a stock option, it needs volatility. And with that volatility, you have no price movement, and without that price movement, you pretty much have no chance to turn a profit. So it's all about volatility when it comes to earnings. So then the question becomes then, how can you find that volatility and then turn it into your advantage? So for this very important reason, volatility, I've put together a process I use to build out a high probability trading list of stocks to follow, to look at, to trade into their earnings release. And what I'm looking for, again, is that high volatility stock that have weekly options. So whatever stock I'm looking at for a potential earnings trade, it has to have weekly options. And I'll go through and tell you exactly why. So first off, the screen uses and tracks the following data. I will look at, again, the stock's volatility. And I have a thing I put together to kind of measure the volatility that I'm looking for. It goes back and looks at prior earnings, how that stock has reacted after an earnings release. Did it, spike up X%? And has it done it consistently for, a number of earnings cycles? Or is it a kind of a random thing where it might be up 1% on one earnings cycle, the next earnings cycle you might see it, up 2 to 3, and then it's up 1. So it's very back and forth and not consistent. So I want consistent type of stocks that have, performance the same way each and every time, where they'll usually go up 3, 4, 5%, after an earnings release, either up or down. So consistency is very key to finding the best setups. And then the other thing I do is I filter, my list goes through, I filter it to see which of these stocks they have to trade 2 million shares or more per day, because I want liquidity for my trades. And then the third thing I want to do is I track the straddle costs for volatility into the earnings. Now, if you're not familiar with options, the straddle cost is how you calculate or how you get that implied volatility, how you can measure it. And you do it through a straddle cost. Now, when I was set up this over-the-counter option desk for crude oil, everything was over-the-counter, so you didn't have electronic screens showing you all the volatility measurements and all that stuff that you do on Thinkorswim and all these other platforms. So what we'd have to do is we'd have to call the market makers 2 or 3 times a day to get their actual volatility, And the way that they would do it is just take the at-the-money straddle cost, and that's how you do it, and that's how all the market makers do it, and that's how all these calculations are done when you look at it on Thinkorswim. It's just the straddle cost. So you take that pre-earnings implied volatility, which is that straddle cost, and that gives you the implied move of the stock that they're looking for, those market makers are looking for after the earnings announcement. So then step 5 is I'll look for post-earning moves from a one-day period after the earnings are actually released, and I can look out to 21 days. I'll track it out there to see, again, that consistency, if there's been anything to it, a trend there. So these historical statistics from past earnings showing trends are very important to look at when you're trying to put together your watch list. Now, the second thing I do is I like systems. I like to be very systematic, because if you have rules, it helps you and prevents you, or hopefully helps you not make mistakes. So if you don't have any rules, you're going to probably make the same mistakes over and over again. So in trading, it's important to have a checklist with whatever you do and have rules for whatever you do. So I use this checklist to systematize my trade setup process, and this is great, really important for making the best trade selections and trade decisions. So I do this for any type of trade that I'm doing, but it's very important for the earning trades, because there are certain things that you have to have high probability type trade setups. So the checklist that I put together, I'll look at the stocks, and again, they have to have weekly options, and they also have to have liquidity. Some of these stocks that are thinly traded can have a bid-offer spread of sometimes $1, sometimes more. So, with something like that, it's just crazy. You would never be able to get the spread on, and if you did, you're going to give up so much getting in and out of it. It's not worth your time. It's just going to be worth the market maker's time to take your pants down. So, that's one thing. And then I look at stock. It must have a high pre-earnings volatility. I want as high volatility actually as I can find. And then I'm also going to look for stocks that have had price moves of over 3% in their last 3 earnings cycles. I usually look at 5 earnings cycles at least, but 3 to 5 earnings cycles. And so I'm filtering for something that's going to move over 3%. Now there are exceptions, because Apple, sometimes you'll see earnings where it doesn't move over 3%, but I'll still usually do something on Apple. Now, the next thing I want to do is the day of the earnings, I will look at the implied stock. I will look at that the implied move that the market makers are making, and that's based on that straddle cost. And so I'll see what that particular potential high-low is of that move. And then from that, I can perform what I call, my price target analysis. And that gives me my targets, and then from those targets, I can construct my spreads that I'm looking to put on. And again, I use non-directional spreads, because I don't care if it goes up or down. I just want it to go up or down a lot and take advantage of the volatility, either for a price directional breakout up or down, or a volatility type collapse type trade setup. So then the other thing to do is select the appropriate weekly option strategy based on all this information, and then you want to be able to select those strike prices, the expiration, etc., date of entry, and determine your exit plan. So these are all that pre-checklist that I go through on each trade. Now this is like one of the components here. This was for Google, and this is one of the little tables that I put together for each earning trade that I look at. So it'll show the earning history. This went back 6 cycles, and then here was the earnings on the 16th. So I've got the pre-earnings closing price in here. This is where it closed right before earnings announcement, and then I have that implied move that was calculated, that I've calculated based on the straddle cost, and this, I have this going back. So then I can see statistically, what is typical for Google or anything else. And if I see certain patterns, then I can structure a trade. It helps me structure a better trade based on the patterns that I'm seeing. So it's kind of like those candlestick patterns and everything that Steve does. That pattern recognition is key. to getting some really good systematic, high probability type setups. And the same thing goes with this. So if you just look here for Google, you can see that, the implied moves, if you average all these up, I did this earlier. Let me see if I can find the piece of paper. I just averaged that up, and that's what I look at. I look at that average, and, it's about, I just eyeballing, it's about a little over 4%. And so then what I want to do is I want to look to see, okay, if I have a certain strategy, then I might want to get inside that 4%, or I might want to get outside that 4%, depending on the spread that I'm going to do. And then I want to see, well, what kind of moves does it have 1 day after and then 3 days? Because I use 3 days because I'm using weekly options, so the longest I might be in a trade might be 4 days at the most. But I try to get the sweet spot, which is maybe 1 to 2 days, 3, sometimes. So you can see from Google, I mean, it's, other than this minus 1.54, it's been very consistent around, 4%, 4%, 3%, that's close to 4, 5%. So you can see that the moves of Google, now Google's a high-priced stock, but a 4% move, is not bad. And then look at that one, 13%. So, I try to take the low side for a certain strategy, or if I could get the high side for another strategy. So I have to look at this data in order to help me determine what kind of strategy to put on. And then step 3 is that power of those weekly options. And why weekly options? I don't know how many of you guys trade weeklies, but they're one of the most lucrative trading opportunities that still exist today, due to their defined risk, their low cost, and high levered returns. And the mechanics is what makes this happen for those weeklies. Use those weekly options for all earning trades, and that's done to take advantage of the 2 key elements. And again, those elements are time value and then the implied volatility. So the combination of these elements, when used correctly, creates a winning kind of low cost, and you've got a defined risk trading formula that will generate unmatched returns on your trading capital and in a very short period of time. And this will illustrate, if you're not familiar with the time curve, you can see here how it exponentially just really falls off into zero. So the weeklies, they come out every Thursday, so a new set of weeklies came out today, and then they're going to expire 8 days later, the next Friday. So every day, if this weekly option does nothing, if the price goes nowhere, the option is going to decay by 1/8 or about 12%. So when you're trading, if you can put that to your advantage, then you've got that wind at your back type scenario. So with my option trades, I'm always cognizant of time decay and that volatility in order to try to structure the trades that will have this in my favor, not against me, not the wind in my face, but the wind at my back. So that's a very key element there. Now, step 4 is that if you know which weekly option strategy to use for an earnings trade, then how to construct the trade and when to execute the trade, then weeklies will produce some exceptionally fast profits due to the incredible leverage that they provide you, making them the perfect trading vehicle for your earnings. And I do this by what I call comparative option strategy analysis. So when I'm constructing an earnings option strategy, I will look at for each strategy I'm looking at, for say a stock, say Apple or Google in that example, I've got about 4 or 5 different strategies I can look at, and then I'll look at the risk to reward or risk or return on capital of each of those strategies that I'm thinking about to see which one has the best kind of risk to reward for my trading goals. Now everybody out here, everybody's different, and everybody's going to have different trading accounts, different size accounts, so you're going to have different trading goals. So by doing this analysis, then it makes it easier for you to identify that particular strategy that meets your set goals. And there are times when you do more than one strategy at a time. So the last earnings season I had Tesla. I did 2 different strategies on that. You can do it all the time. Different strategies. Depends on how much you want to take on as far as management. But there are a couple strategies you can put on and use for the same stock. So this is to highlight on one particular strategy I like, and this is, again, these are non-directional, and this was the results from the last earnings season just on this particular one strategy, and these were results from an alert service that I had last season, and so you can see the usual suspects, a lot of these anyway, Apple, Google, FSLR, and if you notice these trades, they're, the longest one was 4 days, which actually I don't, I might have a rule next go around to, not even go 4 days. I like 3 days, 2 days, 1 day. 2 days to 1 day is the best, and I'll tell you that why in a minute. But you can see here the returns, around 20, 25, 30, 35%, and these are, 1, 2 day type returns that happen pretty fast. Now the only loser was the FSLR, and this was actually a nice winning trade right after the earnings release. You know how you can get a earnings release and it gets slammed down or slammed up, and then it corrects and adjusts back up. So that's what happened on FSLR. But on these particular trades, I will just tend to let this type of strategy go until expiration itself. So that's what it looked like here for the last cycle. And these are the 3 that I've done on this strategy this past earnings season. They've all been, winners as well. But one thing, if you think between the line, the thing that you'll see on all these is that they have big movements. So, Google had a really nice movement. Netflix, Apple was just stunning. So, that's the thing that's you take advantage of for these trades. Now, there are 3 type of trade setups that you can actually do. I'll just, if I can, I think this is the pin here. So, I'm not sure if I'm doing this right, but I'm trying. Okay, so when you're into earnings season, there are kind of 3 types of setups. One is that pre-earnings trade, right? And that's when you start out with that low volatility. I'll just say low vol, and it goes to high vol. So there are trade setups for that. You can buy straddles. You can just buy a directional type of trade, but you want to be buying volatility, right? And then the second trade, pin is white. Thank you. I did see that. I thought it said basic color. That is so weird. On my screen, it's showing that it's working. Darn it. Oh, okay. Darn. Well, let me just try to articulate this. I don't know why that's not working. Let me try one more time. I don't want to go down a rabbit hole here, but well, it doesn't like me. So, and the second type of trade is the trade on earnings day. To set up that trade for directional, non-directional type trade strategy that after the earnings are announced, you're going to have this explosive move. So you take advantage of that, and that's kind of what I'm really talking about here tonight, more so than that first strategy. And then the third strategy is to take advantage of a trend after an earnings are released. So you're going to see a lot of stocks that will trend in the direction of the earnings that they had. And I'll show you an example of that here tonight. So those are the 3 situations that you can get in with earnings, which provide some, embrace the risk, not be scared of it. So if you're knowledgeable of what the risk is and how to use it to your advantage, then trade it. So, there are these 3 different types of steps that you can go through. Yeah, I tried on the side. Oh, hold on. I've got a message from Becky. Never mind. Okay. Well, anyway, so getting back to it, so, there are those 3 types of cycle trades that you can do. Going into earnings at buying volatility, at earnings release, selling volatility, or doing a non-directional for a big break up or down, And then the third one is for trading the trend after an earnings release. And I'll show you an example of that tonight. Now, okay. So what is the strategy that I just showed you? Now, how does it work? Now, again, there's several different methods to capture profits from the extreme price volatility. And each method works best based on certain circumstances. And I don't like to actually, me personally, spend a lot of time watching trades all day long. I'm in and out of my trading room and stuff, but I don't want to be glued to the screen all day long. So the method I like to use, and one of them that I teach, involves really not a whole lot of work other than getting the trade set up right and then executing the trade. And it basically is just 4 steps. You buy 2 options and you sell 2 options. Now this may sound like a lot of work or a lot of steps, but once you understand the method, it's it's not that much work at all. It's not that complicated either. So and you'll just use the same method over each earnings season. So it's really pretty simple once you understand what it is. So here's a simple example. Now this was on Whole Foods Market in that first quarter earnings cycle, and this is a trade that was sent out. And this was step 1 was buy the Whole Foods 55.5 call, paid $210. Sell the Whole Foods 58.5 call, collected $100, so that net cost on that step 1 spread was $110. Now the second step was to buy Whole Foods Market 55.5 puts at 187 and sell the 52.5 put at 87. Net cost on that one was $100. So the spread width, if you're familiar with this, is you take that initial spread. It was 58.5 less the 55.5. $300. That's the full spread. Now remember, one option contract is equivalent to 100 shares, so that makes it $300. It would be $3 times 100 equals 300. Less the cost, that trade cost, or your capital at risk of 210. So you've defined your risk, and that net profit potential is $90 a contract. Now, this particular trade made that $90 per contract before commission. And the way I set it up, it was a high probability trade setup based on the selection process and the structure of the trade. So also the maximum loss was defined, and it was $210. So I know my loss, I know my profit, I'm set there with my parameters and my control, my risk. So, this trade was placed 2 days. So say if you had $1,050, 5 contracts on that, $90, that's $450 in 2 days. It's not too bad. And just looking at it from a return on capital, that's over 40% return. So not bad at all, and that's taking advantage of what the market's given you, high volatility. And, if you want to participate in earnings rather than being on the sidelines, this is one of the things that you can do. So it only really took, about a half an hour, maybe an hour at the most, to go through the process that I put together, that steps that I take in order to get the right structure down, and then look at the trade, get the right strategy set up, and then execute the trade. So that's really what it's all about. So then will every trade be a winner? No, but don't we wish that every trade would be a winner? Gosh, well, I don't know. If every trade was a winner, then that's an interesting question. Then life would be boring, I guess, wouldn't it? So you need to be able to find, though, the highest probability trades. And with the high probability system or methodology that I put together that I use, you can have a very high percentage of winners. So, again, if you look back on those 13 trades that I sent out, there was only one that was a loser. And actually, that one could have been a winner, but I try to keep them all the kind of the same basis so I can kind of measure them. So that turned out to be that particular strategy was 92% winning strategy based on the way I did it. So this a big part of this comes from that selection process and knowing the right strategy to put on. So that's really the key, and it's that's really the key for everything in trading, is picking the best setup. So this is basically, on that line, that theme. pick the best setup. And so to do that, you have to know, okay, well, what is that setup? So I can't, go into too much in 1 hour. I'd fire hose you guys, and you'd be brain dead, and none of this would make sense to you. So I just wanted to highlight that. Now, this is that third strategy that I kind of briefly touched on was when you do have an earnings release, and then you get a trend. And this was one on WIN today, and this will show you what I'm talking about here, just to give you some fruit for thought on this one. Now, WIN closed today at 206.63, and then the earnings were announced, and it was better than what they were thinking it should be, and WIN popped up and had a nice move to the upside. So what I like to do then for that third strategy is after that earnings release trade, which will expire tomorrow, then I like to look back, okay, well, what has WIN done over its other cycles? So here's 1, 2, 3, 4, 5 cycles back, and here's WIN when it was at $200 in January. 1 day after the release, it was up 7.89. 3 days later, 7.89, 5%. So if you look at it just across the board here, it cycled to the upside. It trended. The earnings cycle before that, it trended to the downside. The earnings before that, it trended up. Earnings before that, it trended up. The earnings before that, it trended up initially for 8 days, and then it switched and trended down. So this kind of statistical information gives you an idea what to do. And I'll show you a quick glance at what I will be looking at to do probably tomorrow on this. Let me pull up my chart here. Second here. Yeeks, wrong chart. Hold on. Okay, here we go. So you can see that. Okay. So anyway, here's WIN. The thing I like about it, and also you guys are candle guys, and Steve could give you a better input on the candle, but this is a nice looking pattern, number one. But number two, a couple things on my system, I can see my momentum shifting to the upside, which is very positive. I like that weekly candle there. And then what happened here today was, let me pull up a different chart. Can't find my other chart. Yikes. One second. I think my chart is disappeared. Never mind. I'll just pull this one up here. No worries. So let me just maximize this. So what you can see here is what I just showed you on that little graph. Was see this earnings cycle right here? See how it trended up? Now, the way I like to trade this is you could just go out and buy the stock or whatever, or you could buy directional options or an option spread. But for me, the easiest trade really set up for me initially out of the gate is to, and if you guys use Thinkorswim, you'll know what my frustration is right now. Sometimes Thinkorswim, there's so much data that runs through it, it'll lock up. So right now it's done that little lockup thing. It'll unlock in a minute. I was just going to show you. Okay, here it is. So what I'll be looking at tomorrow is, doing I like to do credit spreads, and I'll probably go out to either next week, 8 days, or I'll go out 15 days. So when you notice that little graph that I gave you, it's tended to trend, for 15 days. So even if what I'll do is on a credit spread, I'll look to sell, probably 1.5 standard deviation out below. So I can do my probability of options at the money, where it would be at expiration. And I'll go down here, look for about 1.5 standard deviation. That would be about 81% right here. So I'll be looking tomorrow to probably sell this, if I can see what it is tomorrow though, but sell the 185 strike and buy the 180. Collect $90 a contract, maybe better. I might go, tomorrow's going to be up, so I might have to adjust this. But, if you have an 80% chance that this is going to close out of the money, that's not a bad trade setup. So this is about, and you make $90 a contract, and you only have to sit out for 15 days. Even if that sucker goes sideways, you're going to make that premium. You're going to keep it in your bank account, and that's going to be about, it's going to be about a 20%. Let's see what that would be about. You can see what the cost is, $90, and your at risk is 410. But remember, if you don't understand credit spreads, you're going to look backwards at it, and you're going to think, hey, that's not a good risk reward. But the thing that you have to understand with credit spreads is that you've got an 80% probability that this thing's going to be a winner, that it's going to that at expiration, win is going to be above $180. So you're going in, as soon as you put that trade on, you're going to have right here, actually, you're going to have like a 82% probability of a winner. So those are that's how credit spreads work, and that's, I mean, that's not a bad return if you look at it. That's a 22% return. So I'll be looking at that tomorrow. So that's just one little thing I wanted to throw out there to you guys on that third type of trade strategy coming out of earnings. So what we covered here, and again, I didn't want to fire hose you with too much, but I also want to get to all your questions, or as many as I can. So we went through find volatility, use it to your advantage, a screening process to find those most probable winners, my favorite trading tool, 9-step checklist, and my favorite non-directional. So now, I also realize a lot of you don't know me, period, at all. So I'd also, before we leave here or get into your questions, I'd like to share with you, 2 emails I received recently from 2 of my clients, one in Canada and one in Perth, Australia, down under. So this was from a very special guy. I'll give you a few minutes to read it. So he's an interesting fellow, and his name's Panya, and he lives in Perth. But what you'll notice here is that now, since he's found my option service or whatever, he's found it much easier to understand options. So it's very rewarding when you get type of feedback like this when you're an educator. I know Steve really appreciates it too when you guys send him emails like this. And then the other one was from Miss P, I call her, a very nice lady in Canada. And you'll notice here that she's very grateful for the excellent course content. So now this course that she's referring to was my earnings course that I'm kind of highlighting and telling you guys about tonight. So it's really rewarding for me, when I'm teaching people, that I'm able to make a difference in their trading, and it's super rewarding. So what I'd like to talk about now, before we get into the questions, is how you can really learn more using weekly option strategies for earnings, and some simple things you can start doing now to take your trading, to the next level. And so you don't have to sit on your hands during earnings season. You can actually take advantage of earnings season. So I put together an earnings course last season. I did this live course, and I recorded it, and it's a trading course that I put together to step you through everything you need to know about how to capitalize on earnings. And again, it was a live course. I did it last earnings season, and it got fantastic feedback and great results from many of the members and clients that took it. Now, it's a 3-hour recorded course, and it's 100% content on using non-directional weekly options for your trading, for trading earnings. Now, this course started out, it was supposed to be an hour course. It turned into 3 hours, but that's typically what happens to me. So you don't have to sit through 3 hours. You can have this, as a recorded course. Plus, you'll get the 149 PowerPoints. And I love PowerPoints as much as I do the recordings, because what I'll do is I'll use those PowerPoints as notes. I'll print them out, and I'll have those as my notes that I can go through. And it's, a lot of really detailed content. So the course is 100%, focused on the best type weekly option trade setups for earnings. And then there's one more thing. I know that questions will always come about after you take something new or start something new. So what I'm going to do is I'm going to go ahead and also throw in an accountability and support call, that I call it, for the first 50 people here tonight that purchase this course. So it's a, I've been doing this for over 30 years, and this is a great value. So it's called powercycletrading.com/value, and it's $97. So you're going to get, all of this, the recorded 3-hour modules, the 149 PowerPoint. You're also going to get, so you don't have to do all your work yourself, all these stocks that I was kind of talking about tonight, this work that I've done, you're going to get all of those in a spreadsheet. So you can use these over and over each earnings cycle, not just this one. And then since this is an option course, you're going to also get the other course I have. It's called Option Trading Made Simple, which is a great course on option delta. And then for the first 50 tonight, you'll get that accountability call. So it's a lot of great stuff. And again, if I can put it in here, I'll try to paste it in here, and you guys can just put it into your URL. So does everybody see that? Becky, can you give that to everybody? I appreciate it very much. So here's what, what's in the course itself. It's going to cover my favorite non-directional weekly option strategies. Hold on, I got to send that stuff. Oh, there it is. Okay, can you guys see that now? So it's powercycletrading.com/value. And for the first 50, you're going to get that earnings follow-up Q&A. Now, that'll be next week. But in the course, you'll get these non-directional weekly option strategies. There are 4, I believe actually there's 5 actually in there. They're all defined risk strategies that are non-directional, and each strategy is explained in great detail using actual trade examples. So those 13 trades that I showed you, those are all in there. I call it the earnings trade library, and so all 13 examples from that season are in there with all the detailed analysis, how I set them up, how I analyzed them, the strikes that I used, why I used it. It's very detailed, great information. So I'm kind of a visual learner, so I like to look at things and see, like on math problems, I like to go work the math problems through and things like that, so I actually get the result myself. So you can go through these trades and get those results, and then you can see how they're structured and why I did it. So you get all that. That's a big part of it. And then, how through that to select those best strategies, how to calculate those pre-earnings implied volatility. If you don't know how to do this, I teach you that in the course, how to use the straddle cost, how to calculate it, and then how to put together those targets. That's the big part of it. And then how to trade the implied projected move, and then how to use those historical statistics for each stock, selecting the best trade setups, how to take advantage of high option volatility earnings plays, and then, how and when to set up the trade, how to manage it. So I take you through some defensive strategies if the thing goes wrong. There's one really great defense that I put together for Tesla that turned in a $700 per contract loser into a break-even on a runaway freight train trade that I got wrong. So that's in there. That's worth the price of admission right there. And then which strikes work the best? Should you go far out of the money, in the money, close in, and much more. So then again, you get that watch list, 40 trades, and you get that accountability call for the first 50 here tonight. So all in all, it's a lot of great content and information, and one of the best things, it's $97. And if you don't like it after you buy it and you look at it and read it and all that stuff, then if you don't like it, you just send me an email, I'll give you your money back. So it's a win-win situation for everybody here, hopefully. And even if you don't want to trade earnings, at least you've done your homework and you've looked at it to see if maybe it is something that you should be doing. And so you have all that information there at your fingertips, and it's yours forever. So that being said, I like to take as many questions as I can here. Let me go back up, see if I can look here. Where am I? Okay, got one question here on the straddles and strangles bought straddles and strangles on weeklies 1 day before option expiration. Well, that's exactly what you don't need to be doing. You don't want to be buying options, basically, unless you're doing it for the right reasons. You know, because volatility, if you just look at, let me show you something here. That's why, you know, you need to buy this course so you don't make mistakes like that. And for $97, you probably lost a lot more money than $97 by buying strangles and straddles. If you look here, this is when. This is the volatility on the day right on the day of, you know, its release, 108%. So you can see the normal volatility for win is about 30. See the average, and then this is exactly what I'm talking about. See, it's 108. That's win. We had a couple others here today, LinkedIn. So see LinkedIn here, 159% vol, and the average is more in the 40s. So you have to know, you know, before you start playing around with these things, you really need to know what it is you're doing in order not to get run over. So for $97, you know, you can go through this course and you may love it. And you may just want to trade nothing but earnings. I've got a number of people that all they do now is just trade earnings season. But after you go through it, you may decide, well, I don't want to have anything to do with it. And the only cost you have in it is $97, which the guy that was buying straddles and strangles and lost all of his money, if he'd probably, you know, had a chance to go through this course, he probably would maybe not have done that trade. I don't know. But so, you know, that's part of education, is learning from mistakes. And the best way to learn from mistakes is to learn from other people that have made those mistakes. And I've made those same mistakes too, so that's why I know. So, you know, in this particular course, you know, I'm going to save you making those mistakes because I've made them before, and then I've structured my trades now going forward differently. So, you know, the basic thing is, you know, selling premium is one way, but there's the other side of this is, you know, looking for that directional big pop up or down. So that's the other type of trade setup that I really like. Looking back through these questions here. How long have you been trading options? I started playing options. I started trading options back in 1987, and I traded. You know, we were the first. My group was one of the first to trade over-the-counter options on Brent North Sea crude oil. And we were just, at that time, we thought it was like taking candy from a baby. We thought we'd found the money tree, because these Wall Street guys came in, and we thought, oh man, we're going to take advantage of these guys. And they taught us enough about options that they made a lot of money off of us. So I learned. So, you know, with this $97 course, you're going to learn all these lessons that I learned the hard way. But fortunately, it was not my own money then, but what we were doing, we thought, you know, selling premium was just unbelievable. So we were just raking in all this cash into our bank account. I mean, it was just incredible the amount of money we were making. So if you're a credit spread trader, the easy part of the trade is putting on. The hard part is keeping it. So I found out that lesson the hard way. So when I say credit spreads, or if you ever hear me in the future talking credit spreads, I'm talking from experience, believe me on that. Oh, great. Well, thank you, Charles, for buying it. And Brenda, got a bunch of orders coming through here. So again, please, you know, sign up here tonight, and you'll get that first slot, those 50, because the Q&A follow-ups can be extremely helpful. And with this course, you know, there's a lot of stuff to go through, and if you're not familiar with it, you'll have questions, and you can just write those questions down, send them in to me, Larry at powercycletrading.com, And then ahead of time, I can put those on the queue, and when you get into the Q&A, I can go straight to those questions and address them. So, a big part of learning anything is that question follow-up, and so I'm happy to do that because I want everybody to be successful and, make a lot of money. So I'm trying to go back here. Question, when will you use debit spread? When will you use credit spreads for earnings play? Yeah, thanks, Peter, for that question. That's a great question, too. And that is a big part of the looking at the volatility, looking at the implied move, and then looking back over the history of that particular stock you're looking at and seeing what it's done consistently. Has it had a big move up or a big move down consistently on each earnings, or is it a random type of stock where, like I mentioned a little earlier in the presentation, it might go up, one earnings cycle, you'll see it go up 3, 4, 5%, or maybe even 13% like you saw in that Google trade. But there's one cycle where it was only up 1.5%, and then the others it was up 3 to 4%. So you need to look at those statistics to get an eyeball idea. Okay, this is a stock that really takes off and moves hard, up or down. And like Netflix is a perfect example. It's one that will just move like a banshee, up or down. Look at the last one. That it's amazing. So on that one, I always do a certain directional type of trade setup. That strategy there. Now on others that consistently don't make their implied move, those are the ones that you're going to want to sell premium on. But the thing is, you've got to do your homework and go back and look at them. So in this course, it's going to step you through that homework. There's nothing free out there, right? So you've got to put in a little bit of time. But in this course, there's plenty in there that you'll be able to walk away with and use. Now, maybe you won't use all of it, but you might. If you're already an experienced trader, I'm always constantly looking at new courses because even though I've been trading 30 years, like I say to my clients, there's no perfect trader. There's no perfect system. Trading is a journey. We're all on that journey, Steve. We're constantly, everybody's learning. So we don't have the Holy Grail. So I'm constantly learning what I'm doing. And every day, that's what I love about trading and being here with you guys is talking the book, talking trading, all that stuff. It's great for your mind, your mental makeup, So we're, I'm getting on up there, but I love it because it's such the mental aspect of it. So, if you can get courses for $97 with all this information, I would recommend you jumping on it. Plus, if you don't like it, like I said, I'll refund your money, but please don't let me do that. I think you'll get enough out of it. It'll be worth this is like a dinner date with your wife, right? Okay, well, Ed, good question. What are the dates? Ed, this course here, let me give you the link. This is a recorded course that I did. I did this in the first quarter, and then the whole course was recorded. So let me show you what all's in it since you came in late. So what you're going to get, this was a recorded course I did on just non-directional weekly option strategies for earnings. And so it's a 3-hour course. You get all the recorded modules of that. You get the 149-page PowerPoint that was put together for it. You get my cheat sheet, the 40 best stocks. So these are stocks that you can use, and I go through a process of looking for those stocks with over 2 million shares traded, over 3% implied moves. So these stocks have all that criteria. They were screened for all that information, and they're something you can use. You can use these each earnings season, pick out these stocks. And then you also get my course, Option Trading Made Simple, on my website is $147, I believe. So you get that. Since it's an option course, you'll get that. And then for the first 50, we're getting close to, got a lot of orders coming through, but for the first 50 that sign up here tonight, we're going to do an accountability Q&A call that you guys will all be invited to, and it'll be next week. You'll get an email on that, and that'll be for an hour or as long as it takes to get through all your questions. And so you'll get all that, and it's just $97. So, you know, like I was telling the guys here earlier, that even if it's not your cup of tea, at least you get to, you know, give it the eyeball test and kick the tires to see, well, maybe this is something I should be doing. Because I remember I used to get so frustrated during earnings season. I was like, you know, I hate earnings season because, you know, you just can't do anything. But now I love earnings season because I know what I can do. There's certain, you know, different trades that you can do. So, you know, I tell my clients, you know, embrace risk. Don't fear it. So if you know how to do it, then go for it. Yeah, $97. Well, I hope it's enticing, Bill. I mean, you can't even go out to dinner for two in Austin for $97. So this is, you know, once you eat, you don't. This doesn't go away. This is an investment in yourself, and it's yours for, you know, it's yours. You walk away with it, $97. It's yours. And if you don't like it, what's a better deal than you throw it back to me? You still got the course, and I give you your money back. I like that. So there you go. So can you see that link there? It's Power Cycle Trading. Somebody said they couldn't see the screen. Yeah. Yeah, I'm a big stat guy. I like to look at statistics on whatever I do. And with options, it's really all about statistics and probabilities. Trading is all about probabilities. So I like to look at the standard deviations, and, you know, I go in depth on credit spreads and how to do standard deviations and implied volatility. But in this course, you'll learn how to calculate those implied volatility moves, which is basically one standard deviation. So it's all laid out for you in this course. You know, I really hope you guys will sign up for it and see a lot of nice water. So I really appreciate it a lot, and I hope to see 50 of you guys here next week on this follow-up Q&A. So thanks, Bill, for signing up, and Ed. Yeah, Austin is expensive for dinner. 97 for two people. Well, I don't even know unless we went to. You can't even get barbecue here for $97 for two people. It is pretty expensive now. Okay, the invisible pin. Well, somebody said the invisible pin was a great ploy, but I did not do that because I don't know how to use this. But I'll type it in there for you. The first type of strategy. Okay, there are three types of strategies I look at, and that wasn't an invisible pin. So, is you want to look when you're going into an earnings release. You want to volatility starts out low, right? So normal volatility is around, say, 30 to 40%. Okay. So what you want to do when you're going into an earnings release, and in this you can start sometimes 2 to 3 weeks out, and it'll vary. And then the strategies that you're going to do there, you're going to be buying option strategies. You're going to do those type strategies. And there are several to do, and it just, again, it's going to depend on that particular underlying you're looking at. And then the second one will be on earnings release date. So today, you know, like when, in those, you're going to be looking for, there are two different types of strategies there. And one is for directional, I'm typing this out, and the other is selling vol. So those are the two strategies there. And then the third one, which is also a great one, to really take advantage of this, you guys, and tomorrow, look at when, this will be one tomorrow, is to do a directional strategy based on the after earnings move. And then what you want to do is go back and look at whatever that stock is you're looking at. When was a good example, and it tends to trend after its earnings. And then you can do some kind of directional trade on that. So it's up to you on that. But what I like to do are credit spreads, because then even if it doesn't trend, even if the trend goes sideways, I'm still going to make money. So those are, without the invisible pin, those are the three types of strategies that you can use for each earnings season, and then within those, number two, well, on each one of these, then there are 3 to 4 to 5 different strategies you can use there. So that's you know, good stuff for all of you guys, and that's, you know, just that kind. You know, guys, I've been doing this. Steve and I've been doing this for a long time. So just these little things that I'm throwing out. The other thing that, you know, I wanted to say is that to try to go to as many webinars as you can, and if you get opportunities to take cheap courses or expensive courses, take all the education you can, because, you know, this stuff all adds up, and the more you learn, the better you're going to get at it. And the more confident the more confident you are, then the more profits you're going to make, because, you know, trading is really a mental game, and the way to overcome the mental part of it, where you're hung up on not doing anything, you're frozen, and you're scared, you're fearing risk, is to embrace risk, and you do that by understanding what the risk is, and you understand the risk by knowing everything you can possibly know about a certain type of strategy. And then once you learn those strategies, paper trade the strategy. Don't go out there and buy 30 contracts on one of these things. You know, go out there and first, you know, go through the motions, paper trade it. But some guys don't like to paper trade, you know, and I understand that. So just buy one contract or something, see how it works. So that's it, you know. And then it'll make it that much easier. Anyway, more information the better. But then you don't want to get over, you know, you don't want to get paralysis by analysis either. So I try to keep things as simple as I can. So any other super duper questions here? And yeah, if you have any problems, you know, these orders, I mean, we're a small company, so we have good service, but, you know, just bear with us. We'll get everything there. So when it comes in, you'll definitely get everything. And you can just, if you have any questions at all, feel free to email me, Larry@powercycletrading.com. And the other one is just support@powercycletrading.com. But we'll get everything done for you. And I really, again, appreciate everybody coming here tonight. And thank you so much, Steve, for letting me, you know, be in front of all your great community. Yeah, we'll send you an autoresponder email confirmation on that, so you get everything, Barb. You'll get a mail confirmation on it, and then you should start getting everything, you know, tomorrow, access to the recordings, the PowerPoint, the trading list, option trading made simple, and then you should be, you know, you should be on the list for the Q&A as well. So we'll go through that, but everything should be good, I think. And good luck earnings. So, you know, take a look at WIN tomorrow. See what it looks like. You know, we've got that non-farm payroll number coming out at 7:30 Central. And that could, you know, upset the apple cart a little bit, but hopefully not. So fade that, see what the actual market does after that. And then what I'll be looking at is that WIN trade. I'll be looking at to bull put credit spread on that, probably 15, 20 days out, maybe even next week. You know, we'll just see where the options are being priced. Well, thank you, Marty. Very appreciative of that. Yeah, defending, good, Elliot. Yeah, what do you do about defending positions that you're in? Yeah, there are a couple of strategies for that, and one of the best strategy. These weekly options move so fast. There's one really good strategy in there that I teach for defending if it goes against you, and you know, it's probably the best one. But there are about 3 or 4 good ones, but in this course I go through a couple, and one of them is, you know, outlined with an example with Tesla. And I told the members here earlier that I had 2 strategies on that. I had one that was a directional option strategy, and the one of them I'd sold volatility. I sold the Tesla and sold vol, and it just collapsed. It was, I think, the last earnings cycle. Remember when Tesla just cratered? Man, I was short the vol on that. So I had this defensive measure strategy that I put together. I do a lot of credit spreads, so it's one that I knew, and I implemented it, and thank goodness I did, because it was like, I think I was down $600 a contract. Well, it would have been a $600 loser. I wasn't down that much because I did. You have to do defensive strategies before they hit your strike. And so I did that with this strategy before it hit my strike. If I hadn't done anything, I would have been down 600, but I turned that thing using the strategy. I turned it into actually a break even. So it's in there too. That alone is worth the $97. Yeah, this course teaches you. We use just weekly options, and so there's a 13 trade example library in this course. The 13 non-directional trade option trade, the certain strategy that I like. So every trade that was done, that trade is documented with all the analysis. So you can go through that analysis and see how it was structured, and that will really help you to kind of see the weekly options and how to put them together. Hey, thanks, John. Appreciate your order, and thanks, Henry. Appreciate your order as well. So, and Abby, you just got here. Well, if you're interested, this course is all earnings, 100% on non-directional option strategies for earnings using weekly options, and it's a 150-minute or 3-hour program with 149-page PowerPoint, and then you get my cheat sheet, my 40 best stocks for earnings, and these are all done on a filter that I use. I filter the stocks based on trading 2 million shares a day, having over the last 5 earnings cycles at least a 30% move up or down, and some other things that I put in there. So you get that list of 40 stocks. So you can use that every earnings season. And it'll show you the implied moves and stuff on this current season. And then you're going to also get a support call, and you're going to get that'll be next week. So you get all that, plus my option trading made simple course, which is, I believe it's $147 on my site. But since this is an option course, I went ahead and put that in there too, because it goes into how to use option delta, and I thought it'd be a nice compliment for everybody. Yeah, win closed at 206.67. It's currently 212. So we'll see what it does tomorrow. But if it starts trending, I'm going to fade the first hour or so, and then see if it's trending, and then I'll be looking at a bull put credit spread on that to take advantage of a trend. And that way, even if it doesn't keep trending out, because this market's been kind of weird. We've had the S&P up, the Dow up, almost new highs, but the Nasdaq and the Russell's just been crushed. Nasdaq's trying to make a comeback. So, even with the bull put credit spread, at least you're, fairly kind of low risk trade there. So, yeah, I appreciate it, George. Yeah. Yeah, good. Thanks, Marty. Yeah. Yeah, really, straddles and all that stuff, I hear what you're saying. Some of the better strategies, in my opinion, are just to, buy like a call spread going into, try to find something that's trending. You can go look back at certain big stocks, and they'll tend to, trend into earnings somewhat. So, you can structure some call spreads. That's what I usually will look at. And I know what you're saying about the straddles and stuff like that. It seems like intuitively that would be the way to go, but you're right. It sometimes doesn't pan out that way because other things factor in with the directional problems and stuff. Yeah, we have a trading room. Yeah, we have all that stuff. You can send email support@PowerCycleTrading on any questions that you have. And we do have a telephone number. You go to our website and you can find that. What is a bull put spread vertical? Yeah, that's exactly what it is, HG. Selling a vertical spread out of the money, that's a bull put credit spread. So, go out there and look at, roughly speaking, I'll look at a 1.5 standard deviation. So that would be, if you're looking at delta, look for, say, a minus 20 delta for your short leg, something like that. See what that's being priced at. And then I'll be looking at a $5 wide spread, short leg at a 20 probably delta, and then a $5 wide spread, and then see, what type of credit I can get for that, and then see if it's, worth it to me risk reward wise. So, you'll have the access as long as you want it, Viv. So you get the PowerPoint, it's a PDF, so you get that, and then the recordings, we have those digital in a cloud type thing, but it's yours for as long as you want it. If you go away and come back a year later, you can still get it. We're pretty easy about everything. And like I said to everybody earlier, we're a small company, so it's basically me and a few of my assistants, and I'm trading and then just doing some educational stuff. So I mean, we're not one of these online traders academy, with phone banks drilling everybody for coming in, all that stuff. So I'm a trader at heart and by background, and then I started doing this because I enjoy it. Plus it's fun, and plus I can actually make some money off of my experience. So what's wrong with that, right? Capitalist at heart. How long is it $97 open for? Not long. I'll be losing money. Well, it's open tonight. If you want to buy it tonight, then you get that. If there's any spots left, the first 50 will get invited to the Q&A, and then that's going to be next week, Wednesday night. It'll be. I believe it's going to be at 7 o'clock Eastern. So, and that'll be a follow-up, and then you guys can get your questions all lined up ahead of time, and then we can go through trade examples and stuff like that. So it'll be a good way to follow up. Yeah, that'll be recorded too. Yeah, we'll record that, and then you'll have access to that as well. Mo, did you just purchase? Mo Miller, did you purchase? Okay. Let me look here. We'll put it this way, you're in. I'll just write that. I mean, there's just so many in here, but you're in. So I'm going to write your name down and make sure that I remember. Moe, that's a pretty name. Okay, you're in. Yeah, all weekly options. And I did this again. I learned this from experience. Okay, when I started doing earning strategies and stuff like that a couple years ago, I was just there weren't as many weekly options, so you were pretty much forced to use monthly options. And so what happens? I don't have a pin. I can't use it, but the pin that I had here doesn't seem to actually work. I don't know why. But so what would happen is I had one or two, specifically remember Akamai, AKAM. I did a monthly option spread on that. And, it broke hard. I think it went down real hard for a couple of days. And then it, started trending back up. So, I lost everything on it. So what happened was that obviously it hit me in the head. Okay, well, you need to make these as short as you can, because things can only go down so far or up so far, and then eventually value will be discovered again, and people will come in and either buy it up or sell it off, right? So you want to be in and out of these quick, so nobody, you want the market to be stunned, so 1 or 2 days, let the thing fall apart, everybody's too scared to get on it, and then the rational behavior comes back, and buyers or sellers will come back in. So I found that the sweet spot is, these trades when you put them on like on a Wednesday or even a Thursday, so you have, or Tuesday maybe, so you have 3 days maybe at the most to be in the trade. Because if you stay in them too long, then something, the more time that it has in the marketplace, and the more potential it's going to reverse and go the other way. So that's the reason I always use weekly options. Jesse? Jess. Jess, what's your last name? If you don't mind putting it in, I'll just check. If not, I'll just make sure. Oh, you're welcome, Gene. Okay, so I got your name, so you're in. I'll just make sure. You guys have been really great, and but you're in. I'll guarantee that. High frequency. The high frequency traders post market. They're in there after the markets. When the markets, the overall market's not open, then you see a lot more manipulation than once the market is open. Because once the market is open, then not only do you have the high frequency traders, but you're going to have the investors that maybe bought options. Like when I was talking earlier, they dump their stock and buy options, or maybe they have stock too, and the stock gets hosed, and they have a stop that they have to hit, so they're out of it. And that way, the high frequency traders can actually help you. So, it's a zero-sum game. So, the high frequency traders, they may actually be helping the trades, not hurting the trades. If you know what I'm saying. It depends on what side of the trade you're on, right? Yeah, Wynn had good earnings. So, in Wynn, if you look back over its cycles, it tends to trend. So that's why I'm looking at if it's up tomorrow after the market opens for the first hour or so, then and it's looks like it's going to hold up, then that's when I'll say, okay, this is trending, going to probably trend, and then I'll look to do that bull put credit spread as that third strategy. Yeah. Okay. So Gene, what I'd be looking at, and this is just a general ballpark. Let me just show you here real quick, since this seems to be a popular thing here. And credit spreads are really great trading vehicle. Let me keep the URL up there for anybody that wants it. So it's Power Cycle Trading. Here it is again. And let me show you the couple ideas on the Win trade. So here's let's pull Win back up. Okay, so I'll be looking at I'll look at that 8 days out so next week, and I'm also look at 15 days because my analysis goes back. It looks like it trends through 15 days, maybe 20. So I'll probably be okay with 15. So I'll either look at 8 days, and then what I'll look at is like if you have Think or Swim, you can put in this tab here. It's pretty cool. You can just put in implied volatility out of the money probability, and this pretty much gives you the standard deviation. Well, what it's telling you is the percent probability that a certain strike will be, it'll be at that money or out of that money. So if you look at this example, this is 8 days to expiration. So let's say, what if tomorrow we come in and I want something that's like close to a standard 1.5 standard deviation. That's going to be roughly a 20 delta, minus 20 delta. And then Thinkorswim's cool because they'll have this probability out of the money. So this is saying that as soon as you put this trade on, if you were to sell that 190 put right there, there's a 70%, 75% probability that at expiration, the price of win is going to be above $190. Okay, so that's roughly one standard deviation is about 68.2%, or about a delta of about 30. So I'll go out and I'll look at 1.5 standard deviation. So I might look at selling that, maybe the one. I'm just saying what if, okay? And let's say you could sell that 185 put right there. So I'd sell that, and then I like to do a $5 wide spread, so it's $500, and I buy the 180. But that's only 27 cents, so I'm not going to do that. It's not enough. So you have to look around and see what you can get. So it might be the 190, and then the 185. And that's good. See, 218. Now that's almost a 1-to-1. That's a really nice. I mean, if you get it, you probably won't be able to get this tomorrow because you're going to have a little time decay in there. And then, if win is up, that'll go down. But still, let's say what if you could collect $200, that is a great trade setup. So that trade setup there is saying that there's only a 25% chance that win will be at 190 at expiration. There's a 75% chance that it's going to be over 190. So as soon as you put that trade on, you've got a 75% chance of winning. And then if you were to collect $218, that is a killer trade. So that would say, you're going to make $218 if it's closed above 190. Your maximum loss is 282, so it's almost a 1-to-1 risk reward. That's fantastic. That's a huge return too. So that's the concept. Yeah, that premium will be much lower because you're also going to get volatility crushed. See, look at the volatility here. That's a really good point, Cherie. So you can see the implied volatility on the front month when it closed today was 109. The second month's 55. So this is going to be, normal is about 30, 35. So these premiums will go down big time. So that won't even be close. But you look at it. So you might have to go out 15 days and see what you can get. See what you can get. So, and then now you have to understand that a credit spread, you might think the risk reward is not worth it, but what you have to understand about credit spread is that as soon as you put that credit spread on, if you're selling something like here, this is a 1.5 standard deviation out of the money, but if you sold that 185 put and you did a spread, there's only 81% chance of this thing being at $185 in 15 days. So you have to, if there's a high probability of you winning something, the reward to you is going to be less, right? So that's why you're going to get less return, but the probability is going to be great in your favor, so you're going to be getting less. But I'm happy if I can have an 80% chance of making money. I'll take less return for that, and I'll do those things a lot. Yeah. So that's the concept behind that. And let me see if there's some other questions. I appreciate Steve letting me take as many questions as I can. Yeah, that trade had to be. I'm just what if trying to show the probabilities here. So it'll all change tomorrow because this volatility will come down. And you may not want to do that. You may say, okay, well, volatility comes down. I'll, look at maybe a directional vertical call spread, something like that. But anyway, first off, do your own homework. So go back and look and see how these things trended. The other thing too that you need to understand too. Now look at the chart. Now, just from a standpoint of my system, I have my momentum indicators have shifted to the upside, and this cycle 2 is about to go. When that goes to the upside, that's even more strong. Now these are decent looking candle patterns here. Steve can tell you better than I can, But, we're coming into this 21 EMA. That's at 210. If we get to open above that tomorrow, and if we have non-farm payroll, doesn't butcher this market, if it's just neutered and the market has a nice response, then this is the type of trade setup that will take off. Now, if non-farm payroll hits the whole broad markets, you just don't want to do anything. You just have to wait it out. So I'm not jumping on anything until I see the dust settle. So those are things that you have to just kind of look at. But you can see here when my cycle indicators shift back up, you can see that trade. Just if you're looking at when, you had a nice little pop here, just from a technical standpoint. So what I'm looking at here, though, just my thesis is that if you look back at past cycles, you go back about 5, 6, it cycles in the direction of the earnings after they're released. But not every one of them goes, nice trend like that. Some of them might just go sideways and then come down. That's why, I will look at that bull put credit spread if I can make sense of that. I'll look at that first. But, trading is about opportunity and probability. So it's just something for you guys to look at. No, you don't need to have TOS, Marty. No, you don't know. So in the course, it'll teach you how to calculate straddle price, and then you don't need TOS. You can use any platform because you'll have the same information. They just have everything automated for you. So you don't need TOS. I have TradeStation. I use TradeStation, Schwab, Trader's Edge. I have those accounts too. Yeah, so it's a good challenge, but it's good mind food to go in and start learning about other things. And the good thing too is it's a low price course for you to get into and start studying. And if you like it, then you can go to the next step, right? So low level introduction, but it's good content. Trust me on that. It's good content. Let's see here. Yes, there's defending the trade is part of the course. So you'll see that in the course. And I mentioned earlier, there's one trade that I did with Tesla. I showed the example of that, and that's a certain defensive strategy that I've developed for a trade gone bad. Yeah, the course is taught using the TOS platform, Ed, because that's for options. I use TOS. I mean, for my trade execution, I actually use TradeStation and Schwab because I have most of my money in those places. But TOS, I use that too. But their platform is excellent. And the other thing too, if you don't have the platform for TOS, it's a free platform. That's Thinkorswim. It's TD Ameritrade. I'm not, I don't get anything from TD Ameritrade. I wish I did, but it's if you sign up for an account there, it takes you all about 10 minutes to open an account online, tdameritrade.com. As soon as you open that account, it takes 10 or 15 minutes at the most. Then they give you the downlink, the upload or download the Thinkorswim platform. And then it's yours to use. You can use it. They're getting so big that they just want to get you in there using their stuff, and then you get hooked on it. It's like not I've ever taken crack, but they always say it's like you can't stop. Once you get that candy, it's just. I always loved TradeStation. I still like TradeStation, and I use both of them. But the TOS platform is really cool. Yeah, I have these indicators. These are my indicators that I've developed. These are my customized indicators for Thinkorswim, and I use these. I like to trade volatility and volatility squeeze and stuff like that. So it's a volatility squeeze cycle indicator. So you can see here on when this was beautiful trade here. See it started in that squeeze, that consolidation, and then broke out. So I love to trade those. My cycle indicators down here went positive. Beautiful trade set up there. Yep, I sell those. But today is about earnings. And I also have a scanner that scans for all this stuff on Thinkorswim that I've developed. It's programmed with my model. But so excuse me. Any last questions? I know everybody's had a long day, and I want to make sure everybody gets a good start tomorrow. And plus tomorrow's TGIF, right? We're all going to look forward to that. SUNY? Sure. I'll look at that. Let's look at that real quick. This is what I call, it all depends on tomorrow, but this looks good. This is what I call a retracement trade. This is definitely something the non-farm payroll, subject to that. This is definitely a trade to get into. See, this is a 50-day moving average, which is one key moving average I like to use as well. And here's the 21, the 8. So you're getting above all these major moving averages. My cycle indicators are up. And then if you do, I like to do cycle work, symmetry. So if you look at the, you're almost right back to that high. This looks really good. I'm going to write this one down. Now, if you take the cycle from that high to this high, then you can see your next target measure move. So let's put that in real quick while I'm here. So we'll go down to Fibonacci retracement. I'll take that high to low right here. And now we can get targets for the next target zone. So this looks real good. It's already hit its 100% retracement of that high. Now what you're looking at is this 2190, and then after that the 1272 extension at 2345. So you've got targets of, if it gets through this 2060 area, your next target's 2190, and then your next target's 2345. This looks excellent. I'm going to write that one down. Thank you for sharing that. Now look at this. This is something else this is a killer trade here. Let me just do something here. You get me started talking trading. See that? That's a volatility compression squeeze. Now my model identifies these, and when it starts, when it ends, look at the breakout. So a volatility squeeze is like you're just crushing, compressing a spring, or you're having a baby in your hand or a puppy, and they can only sit still so long, and then all of a sudden it explodes. Of course, this was off earnings, but you can see going into earnings, that volatility just compressed. Now, this is one thing. One of the guys asked about buying straddles or strangles. See, if you bought a straddle or strangle here, the price went nowhere. So price went nowhere. Volatility may crept up, but you just didn't get enough bump, and then it exploded. So that's the problem with buying a strangle or a straddle. That was amazing. What a move. Okay. Yeah, you can do your power trading club. Oh, no. Oh, you can, Ed, just send me an email, but I don't know if it'll be the same deal. Everything changes. TNA? Yeah, I'll do TNA. TNA. I like that SUNY. TNA. TNA. Well, it's starting to look a little better. It's definitely something worth watching. You've got, some nice candles like forming here, but I'm also getting some positive momentum. But it's still early. You need to put on your watch list and see if it gets a little bit more momentum. Not quite ripe yet for the plucking, in my opinion, but it's looking a little bit better. See, you're starting, you want to see it get a little bit more momentum. You don't want to have it fail, you know. So it looks like it's not that Sunni was just, that looked really good. Potash, POT. Yeah, potash looks pretty good. Got nice positive momentum. I'd prefer to see a squeeze to take advantage of. You're up here at the highs. Now the thing I do next is when I see a trade like this, this looks good. But what I would want to do for an entry, I would go down to a lower time frame, like an hourly, and I'd wait to see for a compression squeeze and see it's going to consolidate sideways and take a breather, and then usually will trend, the break will be back to the side of the trend. So I'd be on that particular potash, I'd be waiting for something like this to get a compression squeeze and then have it trigger, see if you can get some force out of it like that or something down. This one is even better. So, and then you get in on a break of the squeeze so you get the momentum. But it's had a good run, but it looks good. You know, it's holding that 8 EMA. It's you know, that looks good. And you're at the highs, so you know it's probably going to make new highs. Now these type of trades, when you get up here, these are type trades that I'll do bull put credit spreads because it's less risk in case it doesn't make that new high or break that high and it just goes sideways. But that looks good, you know, it's holding that 8 EMA, positive momentum, not bad. IBB, yeah, let's take a look at IBB. And then IBB. Oh yeah, biotech. Ooh. Yeah, I like this. Okay, this is what I see here on IBB. First off, I love it because you've had a nice, it's just been just crushed, right? Get all the weak money out of it, right? And then you've had a trend line break here. It's pulled back into the support area right here. Let's see, we can do fib retracement too. That's what I would put in here just to see where it is right now. So we'll go from here high to low. Yeah, this looks good. See, it's at the 382. You need the 382 and the 618 to me are the key fib levels. So you get through this 382, this thing has a chance to move. Momentum's up, looks good. I like it. I'd start drilling down at IBB into the pharmaceuticals and see what other stocks in that index look like. And these bull put credit spread. Now the other thing that's noticeable here is you're starting to develop a squeeze. See that? That one dot? It's the first bar into a volatility squeeze. So what I'll be looking at, I'm going to put that on my list too. Sunni and IBB. And I'm going to be looking at the lower time frames. So I like to shift over to the hourly to look for a swing trade setup. And then I'll be looking for a squeeze setup to trigger a buy to the long side on that. So I'll be looking for that. And the other thing I will look at, let me see, I'm going to see something here. This is my scanner, and I actually have all the ETFs up on it. So let me see if IBB's on it. And here's the link again if anybody does need that. So IBB, I thought I had it on here. Oh, here it is, look. See IBB? It's in a squeeze, one bar squeeze. See, my scanner picked it up. So this is what I use to find those trades like you just threw out, like IBB. So I have all the major ETFs on here, and then I'll look for a volatility squeeze. So here's one on, okay, here's another one for you guys to write down. XLK, that just entered a squeeze today. And the green, based on my program, the probability is for a break to the upside. And then there's another squeeze on IXN, probability of break to the upside. Now when the squeeze is triggered, you'll see it in this column. Here's a weekly squeeze. You can see XLK's in a weekly squeeze, probability to the downside, but the daily is up. And then here's a trigger when something's triggered. That's RXW was triggered. So let's look at XLK. Take a look at that real quick. Here's XLK on a daily. Just entered a squeeze. See that? Ooh, that looks good too. Wow. So that's technology. We got that nice pop. So technology, we'll see what goes on with the. This is why you need to, be around other traders and do stuff like this, because everybody, you can't see everything, right? So XLK is one to put on your watch list. It's in a squeeze. It's going to consolidate. We'll see how long, and then it's going to break either up or down. Right now, the probability is for it to break higher. So that looks really good. Apple, somebody said about Apple. So look, here's Apple. I talked about the 1272 extension. I just didn't make up these numbers. These things work. These are Fibonacci levels. It's just amazing math. It's just, look at that. So this is a price high to low, the 1272 extension. Now, if you buy that course, you get that for free, $97. If you just learn the 1272 extension, that's worth $97. Look how it nailed the price of Apple. This is Fibonacci. Now, I put this on. This has been up here for days. In the trading room, I told our members the target for Apple, when it broke through that 618 retracement right here after earnings, it gapped up above the 618. See it here? Gapped above right here, gapped above the 786. So immediately went to the 100%, but look where it nailed it, the 1272. Because there are a lot of programs, these high-frequency traders, they look at stuff like this, 1272. This is all math. They're selling the hell out of it right here. Maybe they had profit, or other smart money. They're looking at stuff like this. They're selling it here. Now, as soon as this is exhausted, it's going to maybe pull back, consolidate again. Then the way to play Apple for the next move up, let it consolidate, get in the squeeze, and break out. That's how you trade breakouts. You get the energy, it takes it up, and then it has to take a pause because it's tired, pulls back. You'll see consolidation. That's it, treading water. That's it, regaining strength. And then when you see the volatility squeeze, which my indicators pick up, then when it breaks out of that squeeze, it usually high probability to trend break in the direction of the squeeze. So here's another example. Apple. See, it broke up. See that trend? It came up there. And then what did it do? See? Had a nice trend up. Spiked up here. Trend sideways. Take a breather. Then it popped to the upside. Now, this is a situation where you could do an iron condor. Possibly. You could sell an iron condor because it's tired. It's taking a breather. So you sell a bear call credit spread. Sell a bull put credit spread. Collect premium. Let it work its way off. You don't want to go too far out. So this might be an ideal candidate for an iron condor. Paul, your confirmation, you should get it like ASAP, but we'll see it. I've got receipts and everything. Again, I tried to explain earlier, these are all autoresponders, so you should be getting stuff, hopefully, ASAP, but we'll make sure everything's good. So support at Power Cycle Trading. If you have any questions, please send it to us, but also remember, I'm not a huge company with tons of staff, so just bear with us a little bit. FEYE, sure. Let me take a look at that. F-E-Y-E. Yes, sir. Ooh. See that compression squeeze there? Boom. This thing has been hit hard, obviously. So it needs to spend some time working a bottom. Right now, you're getting a little positive momentum, but it's too early. Too early. You know, put on your watch list, but don't be jumping in on this thing. You don't want to get in on this thing until it starts breaking some trend lines back to the upside or gets above this 21 EMA and consolidates above that. My momentum indicators are still down. You can see here. Let me show you something on this momentum indicator. If I'd had this momentum indicator back in 2000 and 2008, I would have made a ton of money and saved a ton of money. Let me just show you something real quick, and then we'll call it a night. This is a monthly time frame on the SPX. So S&P 500 cash. See when the S&P broke? See the indicators? Crushed it, right? This thing didn't recover until my indicators went plus right here back in about August 2009. You know, if I'd had this, I could have just stayed out of the market or been short the whole time. So I would have been out of the market for a year, at least not long. So these indicators work. So this is what I used, and this was back in 2000 on a monthly. See that? So I wait. So I want some confirmation. So on that kind of stock, I'd be looking for confirmation, more momentum, and then if you don't have these type of indicators, you want to look for those moving averages to get price back above those and have those shorter moving averages crossing up. That was a monthly time frame, okay? Monthly for macro. I look at the macro trend using a monthly. Yeah, the momentum indicators, any time frame, I can put it. I'll show you my day trading system. It's based on tick charts and stuff. Just while we're here, we trade a lot of NASDAQ 100 futures. So this is a 200 tick chart. This is a 5 minute. So these are my indicators, tick charts. These are support. This is everything's automated. Prior day's closed, high. So this, you know, using this stuff, these indicators with those candles that Steve does, man, it's just killer. You just knock it out of the park. See, so what I do is I look for those candle patterns like Steve does. Steve would be brilliant with this. And then when my momentum indicators both go plus, then I look for a long setup using the candle patterns. When it goes negative, I look for a short setup using the candle patterns. And that's for day trading or anything, but this is strictly day trading. Look, see, here's a squeeze on the 200 tick pops. Now these look like little moves, but these moves add up. We're talking day trading. So this is all, you know, all the kind of stuff that I use, and I developed this system from, you know, all my trading experience. And our company that I ran for, it wasn't my company, but the trading desk I ran for 10 years, we were the first oil trading company to actually use trading systems. And we had just spent millions of dollars on trading systems. And Tom DeMark, he was consulted for us. He did a lot of system help and work and design. He's one of the greatest technicians out there. Paul Tudor Jones, he designed all of his stuff. So got a lot of stuff, you know, over the years that I just put into my simple model, and this is what I use. Now for earnings, I don't use this because I don't need to. It's non-directional. Well, thank you, Sacco. Appreciate it. It'll be a good $97 well spent. So, you know, again, it's an investment in you. It's not, you know, going out to dinner and then you don't get it back again. You'll be able to buy a lot of dinners. Paul, you should get, just, we'll get it to you. Just, we'll definitely get it to you. Just kind of bear with us. I can't see it right now because I'm not the operations person. I can't do everything, but sometimes I feel like I do. But, I will see an auto, we use what we call Infusionsoft, and I think that's probably what Steve and all these other guys use. And these systems are really good. When it goes through, we know it's there. It's there. It's these are really highly sophisticated automated systems. So it's there. When the money is taken, there's an authorizing that auto receipt, and you should get it. But sometimes there are little quirks and tweaks and things that I don't understand, but it's there in our system. We see it. So, if you don't get it like tomorrow and you send us an email, we can go in there and see it, that you bought it. We can see that the dollars are there, everything. So it just doesn't disappear. So you're good. Well, guys, I am so thankful that you guys showed up here today, and appreciate everybody being here and staying in here so long. So good luck trading tomorrow, and I hope what we went over tonight will help you, and I hope this course does. I know it will. And then look forward to seeing a bunch of you next Wednesday night. Oh yeah. So yeah, Charles, let me tell you something. Okay, so if you got if you sign up for the Power Trading Club, let me just tell you guys, the Power Trading Club, you'll get all this information. We do a Q&A every week, plus you get our trading room every day, and you get all my daily video updates and any trade alerts. So I highly recommend that you guys take that trading club, try it out. It's only $7 for 30 days. If you like it, stay with it. But this kind of stuff you're seeing here tonight, you have access to all this technical system stuff for discounts. So you can buy that scanner that I showed you, $150. These custom indicators, I just had a special off of something else I was doing, and I don't even want to tell you how cheap I made it. But we have great deals all the time, and then I'm teaching all this stuff. So I do a lot more than just earnings and options. I do futures. I'm doing a crude oil. My background's crude oil. I'm doing crude. I do a lot of different things. So I would highly recommend that you sign up for the trading club. Have you bought the course? If you buy the course, the $97 course, you'll get the link to it. And if you didn't buy the course, send me an email, and I can get you set up. So it's Larry@PowerCycleTrading.com. But I'd love to have you as a member. Okay, guys, we'll have a great evening. And again, if you have any questions, send them into support@PowerCycleTrading.com. And give me a little bit of time because again, we're not, we're traders and got some support people, but we work our ass off trying to make sure everybody gets what they want. So anyway, that being said, again, thanks Steve and everybody for showing up here tonight. Best of luck trading tomorrow, and I'm looking forward to seeing all of you guys next Wednesday and hopefully ongoing in the future. Thank you so much.